and welcome to this special episode of Investors Hangout. Special because this is the 200th episode. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, before we begin today's discussion, I'd like to welcome Mr. K.S. Rao, who is Head of Investor Education and Distribution Development at Aditya Birla Sun Life AMC. Welcome, Mr. Rao.
Thank you so much, Ruchira. Glad to be here.
Also joining us is Dhirendra Kumar, our CEO. Welcome, Dhirendra.
Thank you.
Now, 200th episode, this is a big deal. This series was started in October 2016, and since then, it has stood with investors, guided them through the thick and thin, be it demonetization in 2016.
No other financial event in the past have affected so many people.
Or, Sensex crossing the 30,000 mark in 2017, or the debt fund crisis in 2018. So, Mr. Rao, I'd like to start with you. It was your brainchild. You came up with the idea. So, I'm curious to know what motivated you to start this series, and how far do you think have we come, and what is the plan here on?
Yeah, thanks, Ruchira, once again. Indeed, it's an honor to be here back, and congratulations to everyone for this 200th episode. My special thanks and congrats to Dhiren. And I'd like to congratulate Dhiren for two things, not only for this 200th episode, but all the hangout. It is not just my brainchild. It is we together were traveling across the country, and these were various conversations around. This is much before mutual fund IEA campaign was launched by industry. What is that we need to do different? And every market where we went, things were very different. And these conversations slowly led how it can bring the scale. What is that we need to do differently? And how we can make mutual funds as a regular conversation. How we can make very informal conversation into a regular habit where people can learn something. And that is where the education can come. And what is that scalable model we can look forward? And these conversations led in once Google Hangout was the famous hangout place at that point of time. Then we thought, why should not we use the technology was just evolving. Google, probably we may be the first financial literacy workshops from the Google Hangout platforms in the country, or maybe in the whole world. This is what the journey which is started. I remember we were doing a lot of our educational initiatives under a platform called Janoge Tabito Manoge. And that is a time myself and Dhiren, we traveled across the country. I had a privilege to be with Dhiren, and post our sessions, there will be what is that best we can do? What is that it can evolve better? What is that we can do? And then one of the sessions it is said we can have this Hangouts model, which we started experimenting. Initially, it was truly experimentation. And today we feel it is truly a power of compounding, power of collective effort, power of collaboration. And more so, this episode success 200th episode is I owe it to only Dhiren, because it comes with an authentic approach of conveying what he means, and investor centric episodes. And each of these episodes also taken us, if I can look at all the 199 episodes which we did, it was fabulous to look at whether we covered every gamut in terms of investments, whether it comes to be a personal finance, whether it is a mutual funds, whether it is the latest trends, whether there is a change in the regulations, whether there is a change in the market approach, or it could be a major episodes like a demonetization or elections, or it's a war, or it's a COVID. And the last but not the least, during the COVID time, that 2 years, probably we have evolved much before 4 years, and which has become much more easier for us to get back to the investors. And when there was an anxiety, how we can get off that anxiety. When there was a debt crisis, how we can, what is that we can give an information to them. I think it's fantastic journey, and I congratulate once again. I personally thank Dhiren for taking this. And of course, we all call him as a mutual fund man. And it is a authenticity which he brings, and the simplicity brings in. And today, wherever I go, in some pockets when I go in person, people identify, oh, you are with Dhiren in this episode, kind of it. That's the credibility of Hangouts today. Thanks once again.
Dhirendra, now coming to you, how has Investors Hangout panned out? What are your views on that?
Oh, very interesting. Great learning experience. And let me tell you some interesting stories. The first time we did the Investor Hangout, it was a 1-hour monologue. And I will actually prepare a set of notes. And One person who was there, working with us, Neil Borate, he will actually, sit behind a wall and ask me questions, and I'll be answering those. So it was great learning experience for us, and we realized that Investor Hangout has evolved from those times, the production values, the content, and then we've evolved the editorial focus in terms of creating a cover story of the top anxiety point which investors might have at any point, and I think it has stood well on all these times, and this has been a very eventful. These 3-4 years have been very eventful.
All right, now getting back to today's discussion. Today we'll split this episode into 3 different parts, wherein the first part will deal with, we'll give investment advice to millennials and young parents. Dhirendra, you have always emphasized starting early. Why is that, and in which funds should one invest while starting early?
Oh, the magic of compounding. It's a magic which is available to everybody. But the initial years, I think they are also habit forming. If you don't start early, then there is a possibility that you will start, falling in habit which is not beneficial. You'll fall in habit of spending and not being very careful about saving and investment. So, both aspects. But, the magic of compounding, the arithmetic of it, just look at the example, 10,000 rupee invested by a 25-year-old person, and he keeps doing it for next, 25 years, and it will be 1.9 crore if it is, growing at 12%. A 35-year-old person starts 10 years later and does 20,000, twice as much, and does it till he turns, 50. And he invests 36 lakh rupees, his principal, and that will be just 1 crore. So having twice as much despite having started 10 years later. So that is the magic of compounding. The saying is that the best time to invest was 20 years ago, and next best time is tomorrow, or maybe today. So follow that.
All right, Mr. Rao, what would be your advice on this?
I think what I take the extension from what Dhiren said about the power of compounding and the power of habit. And these two, how you can make that as a part of habit. Once you make it a habit, it becomes into an auto mode. And when you start your investment as an habit, it becomes just an auto mode. And it's, I think, Aristotle who said you become what you repeatedly do. I mean, similarly, your SIP you repeatedly do for a longer period, which power of compounding works, and which it can create substantial wealth. And the best part of it is none of us can time the market. If I can look at these 200 episodes of our Hangouts, we have seen when we started, I think it was the first event we did in Bombay Stock Exchange. That time the Sensex was precisely under 30,000, 29,000, the Sensex, BSE Sensex. And today at 62,000. And in between we have seen variations. And somebody who was to stick to their discipline and had the commitment, and they continued their SIP, the kind of wealth he would have created or she would have created is the way Dhiren put it, the number to it, that kind of wealth we would have created over a period of time. And what is important is, if I am not committed to that discipline, I tend to withdraw it during the peak period or during the panic period. And sticking to the investment is the most important part of it. And only one thing investors to do is just formulate your own investment philosophy and investment strategy. Then have a discipline of continuing it. Then let power of compounding work for you, and stick to the basics. Honestly, wealth can be created. And if you can make temporary adjustments, probably it will ruin the entire philosophy of wealth creation. All that I can request investors through today's Hangout is be disciplined, continue with that SIP, and create that wealth for you, and diversify your investment in such way. And the investment should become, saving should become a habit, and investment should become a philosophy for the people. And look for your goals. Don't look at the markets. Goal-based investments are always better, and it's not the market or the speculation-based investments. And one need to define, this is the period of the time or year of the time. We are at the cusp of changing the year, and this is a period where you just look at where you have gone right and what is the reflect on what your investments are, and take a resolution how you continue for the next year and going forward.
All right, Dhirendra, any quick key takeaways for investors, for the beginners?
Do anything to fall in habit, because if you don't do that, investing is very difficult. Saving itself is difficult. Saving and investment itself starts with something where you're postponing your today's need, today's consumption for some future date. So falling in habit by doing anything, because is very important, because you will have too many demands coming from either real consumption necessities, or sometimes wishful consumption. So that is one. And then another thing which I would like to emphasize here, that most of the time people coming to me, they think that I will tell them something to do, and they will greatly succeed because I'm an expert. And that is so untrue, because investing is so much about not doing many things, because investing is very little about what you have to do. You have to save, you have to invest, and you should be investing your long-term money into equity. You should diversify, and that's about it. Not look at it. And investing is so much about not doing many things, and not doing many things is like not getting distracted by crypto, not getting distracted by a war, not getting distracted, because you will always have some doomsday proponent coming up and saying that why are you saving, the whole market is going to tank. People come, I'm in touch with a lot of news people, and they come and tell me that there's this big racket going on and the whole economy is going to collapse, then COVID will happen, and we see everything crumbling for a brief period of time. And despite all these upheavals, we saw that in these 6 years of Investors Hangout, it has gone up from 30,000 to 60,000 on a diversified, unmanaged index fund. Yeah. There are investment vehicles which have done far better.
All right, so now we've reached the second part of today's show, which will talk about, giving advice to people to boost their investments. So, Mr. Rao, when anyone invests, the objective is to derive maximum benefit out of it. We talk about power of compounding and grow investments as much as possible. So, what do you think should one do to, achieve that objective?
Thanks, Ruchira, for this wonderful question. I mean, this is always every investor before investing, the first question one need to ask ourselves is what is my purpose of investing? Why I am investing, first of all. I mean, otherwise, if you are not asking this question, you invest at randomly, and there is you tend to lose, or sometimes you tend to gain. But once I have a purpose clear, it is like Stephen Covey, who says you need to have it's when you are navigating, you should know your destination. We need to set our GPS, and then you need to have those correct principles where you are putting it right, so that there are no deviations, there is no confusion, there is no conflicts. And when it comes to investment, if we are investing for our financial goals can be a short term, goals can be a medium term, goals can be a long term. And probably if it is today, for the purpose we say, if it is for the wealth creation, then I need to ask a question: which are the assets I can create wealth for me, and where I am putting my money? And it's but all before, even if you have a right purpose, probably you need to fulfill certain things before you are coming to the purpose. Do you have those corpuses to stay back with this purpose? I look at like this: most of the investors, when they are investing, if they have their emergency fund, if they have their insurance appropriate, then they go for the purpose of investing to create a wealth. They stick to that wealth. Otherwise, you tend to redeem this money for some other reason. You need to take out your money. Then it comes while I'm investing for the wealth creation, probably the proven asset class always is for equity. Equity is an asset class for the wealth creation, and debt is an asset class for you to give the stabilization. Gold is an asset class for giving you hedge against inflation. Means a combination of these assets can make a difference. Then when it comes to particular to the equity, I mean, if you can look at the equity over a period of time, if I stick to those basics and continue to invest, the kind of wealth we create is substantial. Intermittently, there is a period where you may not getting any return. There may be a period you are getting much lesser return. There is a period which can give a very higher return. And if you can compounding, looking at CAGR over a period of time, which is very substantial. Of course, the return comes always with the associated risk. But when you stay for long term, when you systematically invest month after month, and you stick to during good times and bad times to your investments, probably that risk can come down, and risk can be reduced. Probably the asset allocation is another way where we can look at which can minimize the risk. But looking at wealth creation, yes, stick to equity. And even when you have a lump sum money, probably don't put it at one go. Mutual funds got a fantastic tool called systematic transfer plan, where you can put that money into the cash fund and transfer it period of period. and diversify into various asset classes and use that asset class maybe within the equity. If it is like you have a you have a diversified equity fund, or you have a sector fund, or you have a hybrid fund, depending on your goal, you can put it in that kind of equity. And if you are a beginner, please do understand, do spend some time on reading it. Just don't go by the speculation. And when you don't understand anything, diversified equity fund or hybrid fund or balanced advantage fund is the best way to look at and stay invested with this. And mutual funds is the way where you can always create a right wealth, if not substantial. And probably it is much better than directly investing into the equities. And come to the mutual funds, that gives an auto diversification.
A lot of takeaways for people there. But Dhirendra, everyone wants to know which is the best mutual fund. What would you say to that?
It's not only everybody wants to know. This is the most frequently asked question. And there are two parts to this answer. The first part is that, what you need an appropriate vehicle. Because depending on your needs, if you want to invest your money for a couple of months, and if I tell you a great equity fund, you will be definitely disappointed, because it might translate into a decline in value when you need the money. So choosing the appropriate vehicle is the first step. Then comes, generally this question is around equity fund, and the way to start is, there are two factors and even there are 16 kind of equity fund which you can invest in, and not all of them are appropriate. So I would say that, one should be investing in mutual fund for diversification. And the diversified vehicles are the large and mid cap category, or the flexi cap, or the multi cap, or the value oriented fund. These four categories are the diversified vehicles, and this is where one should be doing SIP for the very, very long term, 5-year, 10-year, 15-year, 20-year. And the way to choose a fund is a fund which has done at least for 5 years, and in declining phase as well as the rising phase, which means that the fund will be consistent, and make sure that the fund manager is still around who was responsible for this. So these are the criteria which should guide you in terms of choosing the fund. But there is still a rider for the equity fund, because whatever I may say, how many investor hangout we may have, even 10 years from now, after running investor hangout week after week, people will be extremely disappointed. When COVID happened, the market went down by 30%. If you were starting in the month of January, and in March of 2020, the market went down by 30%, you will be running for cover, looking for an opportunity to take your money out and run away, and never to come back again. To mitigate that, to reduce the possibility of you running away from it, for a new investor, should always start with a conservative vehicle. So where this is where the aggressive hybrid funds are useful, or a balanced advantage funds are useful, because they don't crumble when the market falls, and that is very important for any new investor to fall in habit of investing in equity. Once you have done it for 2-3 years, then I don't think you need any coaching or any hand holding, because your experience and the rewards itself will build a case for it.
All right, so you spoke about unpredictability of the market, but Mr. Rao, how can one decide to buy cheap or sell high? How does it work?
Thanks, Ruchira, for that fantastic question. I mean, buying low and selling high, which is a fantastic maxim, but which is impossible to do. And even those who have phenomenal knowledge, it is very difficult for them to predict. A while ago, Dhiren was talking about COVID and market correction by 50%. And none of us anticipated the markets will go down that period of time. I think that is the time there was a memo circulated by Howard Marks. I still remember that memo talks about very nice headlines, which talks about you can't predict, but you can prepare. And when you can't predict, you can prepare. How you can prepare as an investor is the right asset allocation, and also a rebalancing it appropriate time. And asset allocation can also happen according to your investment goals and what kind of assets you are into. And asset allocation is a very simplest methodology, proven methodology over a period of time, where you are allocating your investments to various asset classes, so that you are diversifying, because the correlation between the assets can make your investments more comfortable. And what exactly happens is, you may not maximize your return, but you can minimize your risk, and where you are optimizing overall portfolio return. You are looking at a portfolio return. And I keep talking people, if you have an asset allocation right, you have an edge of asset allocation. That EDGE is an acronym which I call equity, debt, gold. The other E is either it is a real estate or it's an international equity. When you spread across and there is market fluctuation, so there is a period last year fixed income was not doing great, and where you are holding some parts of the fixed income and equity is doing. This year, I think fixed income has started bouncing back. Then if you have a right allocation, you have an optimal returns. And this also helps you rebalancing time to time, helps investor to periodically book the profits. But if you do not have a wherewithal, at mutual funds have to created some kind of products and even the tools which you have where you can have a auto rebalancing. I mean, some of these funds you don't need to do, but the fund manager will do. There are asset allocation funds, there are balanced advantage funds, there are hybrid funds where you don't need to do anything. You just come and invest, and this asset allocation can happen in auto mode. Respective fund manager is taking care for you.
All right, so you can't predict, but you can prepare. Dhirendra, how should one do asset allocation to prepare oneself?
The rules are pretty simple, and I think in Investor Hangout we have talked about it time and again, and I think it has contributed to greater awareness about the framework of asset allocation for individual investors. Uh, because most investors, regret is unavoidable if markets crumble and you have invested substantially over the years in the market. So my simple formula is that for the initial 5 years when you are getting started, first start with conservative vehicles so that you get used to it, you form your habit. And for first 5 6 years invest in equity only. After 2 3 years change your track, move into all equity and continue investing, because that is the phase when the decline will not matter because you have not accumulated something meaningful. Your regret is greater when you have accumulated something meaningful, assuming that you have built a corpus of 50 lakh, 1 crore, and that goes down by 30%. Then you think that this 15 lakh rupee on 50 lakh rupees that you lost, you could have saved that. And to reduce your regret, you should start your asset allocation just before that, after 3 4 years, when you think that amount is meaningful, and that should be can be 25% of your money. So asset allocation is not a return maximizing method, it is a regret minimizing tactic, so to say. And so this is one reason why you should have asset allocation. And you can well have 100% into fixed equity if your goals are 10 years away. But as you get closer to your goal, start increasing your fixed income allocation, because you need to reduce, you will be more anxious if you are doing, when you need the money and the market crumbles. Second is that you have something substantial invested in the market, and short-term money should not be invested in equity. So combination of reasons why you should have fixed income as well. So investing is not all about equity and maximizing return. Reducing your risk is just as important.
So start conservatively, and after 3 4 years you can be in all equity. But in the later part of your life, while you're planning to get retired, how should one derive income in retirement? That's what the third part of this episode will deal with. Now, Mr. Rao, what should one consider while planning for retirement? What all should be taken into consideration?
Yeah. Thanks, Ruchira. I think retirement is one, everyone looks, everyone discusses, and very few of us will plan. Because it is one goal you can always likely to postpone because it's not happening tomorrow. And it's exactly, and this is one goal, unfortunately, you can't get the loan. And every financial goal of individual can be set by the respective individual. But every individual retirement is one goal which has already been set by someone. You are retiring at an appropriate period of time. And if you are not planning, if you are planned to fail, there is a saying that you have failed to plan. And earlier, a couple of years back, when we were doing these retirement planning sessions, we used to call 30-30 of retirement. You're working for 30 years, and there is a 30 years of life left out for you. And today, like the youngsters, when we meet most of the startup friends, they say, I would like to retire at 40. Then, there is a story about 40 after 40. You retire at 40, and another 40 years you need to spend. That money is there. Then here it is one simple way to look at is your destination is set, what kind of cohort you are, and how you are planning for your retirement. Somebody is at 35 to 45, you can start with a simple investment plan which can create a power of compounding. Somebody at 45 to 55, probably you need to enhance the quantum of investment could be much higher. But somebody at 55 to 60, and if your retirement age is at 60, then you need to look at your whole corpus. And it's like, visualize at 60 what kind of money you are starting with and how long this money will last. I mean, are you outliving or your money is outliving? Then if you are looking at what kind of returns you can look at, probably ROI, normal course, we look at as a return on investment. But for the retirement, this ROI can be multiple way. That ROI can be what is the rate of inflation. That ROI can be a regularity of investment. That ROI can be your rate of interest on your investments, how it is planning. When you are planning, take into assumptions. And retirement, unfortunately, we have many variables we assume. The first variable is our own life expectancy. Second variable is your inflation. Third variable is interest rate structures going to establish in the country. Putting together all, if you can plan for your retirement, probably I personally feel somebody has to sit with a retirement advisor or like financial advisor. That can be a better way. If that is not the case, just take an Excel sheet, then look at what is the kind of income you need post your retirement, where you are standing now, then you can plan. And retirement can be a wider subject. Probably we have discussed earlier in one of the hangouts, each of this cohort, what they can plan. That's where we can look at. And the last but not the least is, however you plan, your lifestyle, what you want to create, accordingly you can modify your plan. And that's exactly you need to look at. Either, if you are looking at your lifestyle is simple, then you need what kind of income. If your lifestyle you want to maintain the same way, how you need to enhance your income.
All right, so Mr. Rao listed out a lot of variables that one must consider while planning for retirement. Dhirendra, what would be your advice for planning regular income in retirement?
No, one is that it requires most of the planning has to be done before you retire. Because your accumulation phase, your working years, that is when you have to prepare for retirement, and and if you have done that job well, retirement gets relatively easy. One should just be conscious of what is ahead. Most youngsters today, they talk of this concept FIRE, financial independence and retire early. But it may not be a very wise thing, because because there are a variety of things happening. People should be aware of this, should be conscious of the societal change, the nuclear family. Our jobs are not going to last a lifetime. Then the need to change our skill, upgrade our skills. And then on top of it, what Mr. Rao said, that, we are going to live longer. If average Indian was living till, average urban Indian was living till the age of 75, and today if he lives till 90, it looks like another 15 years, but it is not another 15 years. It is 15 years. Earlier it was 15 years post-retirement, and now it will be 30 years post-retirement. So you are going to live twice as much, and it has to be provided for. The risk, the nightmare of, outliving your savings, even visualizing that in a changed society where, you might have a home, but your children are gone, and we don't have a joint family system. So in that context, it becomes very difficult. It must be planned for. One must be careful. I think most of great preparation has to be done beforehand. After you retire, you have to just be careful of one thing. Most people are not used to that kind of accumulation from your provident fund, from your superannuation fund, and they don't have the sense of, they get enamored by the scale of money, which they are supposed to manage. And that is where initially, if you are not careful about that, you should just take a stock of things. Make sure that what is your income requirement. Try and look at the kind of contingencies you will be faced with. What kind of emergency fund you should have. Where the money should be invested. You don't have to necessarily, you have to make sure that your money is invested in a manner that it can beat inflation. It can generate little more in return than inflation. That is how it will protect its value. Because if you have a crore of rupees or 2 crore rupee, which might look like a very large amount, but 1 crore rupee, and if you take out 50,000 rupees income from it, and that would be 6% return. And if your investment is not earning 6%, your capital is going down. So 2 years down the line, 3 years down the line, when you need a higher income, you might have capital, and you will start eating into the capital, and you will not realize till you actually hit that situation that your capital is not enough. So be conscious of it. Plan things accordingly. It requires careful planning. It requires very basic understanding of how things work. And if you have, and that is why I feel that every investor in India should be investing in equity for 10 years, because that is when you will be able to develop a belief in the equity. Because in retirement, it is very hard, because you have retired, your income has stopped. A decline in value by 10% of your principal will scare you out of the market forever.
Right. Now, a lot of Indians prefer real estate. They think real estate is a sure short way of getting a regular income, after retirement. What's your take on that, Dhirendra?
Yeah, there are all kind of stories, and the name itself, as if everything else is unreal. This is real, and it is actually real, because you can see it physically, and it's you can experience it. Real estate has a set of problems. It's a big ticket investment. It might be tough to manage. Many a times it doesn't work out the way it was expected or planned, and there is a risk associated with the builders as well. And most of the development today also happens in a format where the old saying is that the real estate framework is that land prices go up if you are lucky, but when you buy a home, everything else depreciates, because the construction, the style, the design. So all those things, keep those things in mind. It's a great idea to be having a home. Considering it as an investment, I think one should be looking at it, looking a more careful look at that option.
Mr. Rao, do you agree with Dhirendra on that?
I'm fully in. What Dhiren said is very apt and very appropriate. Real estate as an asset class, if you want to keep for investment, partly it is fine. Now today you have a REITs, you have a comfort level of investing. But real estate as a source of income post retirement will be a bit difficult. One, your return is much lesser. Second, the time you spent on the maintenance is much higher. The fourth is you are getting into entanglements of many things, which post retirement many of the people would like to have a hassle free life. And your investment, and today you have various financial assets which are available to you to fulfill your retirement income, which will be much more easier, less complicated, and your account is created without even your involvement. Why you need to get into that complications to hold on to it? Probably your house one you are owning, that's fantastic, but don't depend as a real estate rental income as your income. Maybe partly it is fine, but if you are fully, then you are disappointed.
Well, with that, we've reached the end of this episode. Thank you, Mr. Rao, and thank you, Dhirendra, for joining us.
Thank you.
Thank you so much, Ruchira, for this.
I'm sure this episode will help people to plan their financial journeys better. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.